All right, I'm gonna miss you guys too. Bye, birthday girl.
Bye.
Okay, hey guys, what's up? Let's get the garage. Oops, wrong one. Hey traders and investors, Todd, what's going on? Todd here. My wife's leaving for Jersey. She is going down to her parents. I'm leaving soon in 2 hours. I gotta shoot, edit, and post this YouTube video, but just to get you caught up in what's going on in this crazy world, markets and otherwise. So let's dive in. Oh my God. So it's been an unbelievable week. So this is Trisha's real 40th birthday here on March 19th. Last week, Friday, this place was rocking. We had a surprise party. It was unbelievable to try to plan that. Have you ever tried to plan a 40th surprise in the house that you're gonna have it in, trying to get your wife out of the house because she's such a good mom, she doesn't wanna leave her kids? It was really, really stressful. But it was a lot of fun. We had like 35 people here. It was a little bit of a risk because of COVID, I got it. There was two main groups of people that were here. Those two, like we're friends with two distinct groups, but they always hang out with each other. So some have been vaccinated, some are doctors, some have had it, but there's been no new cases in these two groups, so we thought it was safe. So it was crazy to plan that on top of everything that's going on in the markets, which I do want to update you on here, show you what's going on from my point of view. Also, I got to show you my new setup. I cleared the basement out, totally cleared it out because we had the high tops and this and dance floor over there. It was crazy. So here's what the basement looked like after I cleared everything out. And I'm super into tech. I mean, I take it a little too far. And as I tell people all the time on Twitter, like you don't need all this hardware and technology to be a trader investor. If you run a trading and media business kind of like I do, it really helps to have good equipment. And here's what it looks like now. See, I kind of reorganized things a little bit. It was taking up too much space. I wanted to have my couch back to kind of hang out. My daughter likes coming in and watching Moana and Frozen, which I don't mind. I like working at home. It won't be forever. There's an office in my near future. So anyways, here's the setup, and yeah, it's good. A little bit more functional. Bennett built me an awesome new computer, badass computer. And again, you know, I need it to run the streaming software as well as all the software programs we use for charting and trading and all that. Other updates, wealth management is still on. I pushed this back. I was supposed to take it this week. I'm gonna push it back either next week or the week after. I'm just not through it yet, but this is the Series 65 exam that I have to take in order to launch the wealth management company. So that's happening. But anyways, a lot of people are calling, having one-on-one phone calls, kind of slowly moving into it. It's not something I'm just trying to shotgun launch and just get it up. I'm slowly, purposely trying to just roll into it because you know it's a big deal. So I'm having slow conversations. I'm trying to onboard between 25 and 50 people for the initial launch. Probably hang with that just for a year or so, make sure we're solid, and then ramp up to there. Again, I don't want any more than 100 clients in the wealth management business. Keep it small. Trading analysis will continue to run, and let's jump in and show you what's going on with the markets. So guys, the Fed meeting was interesting with interest rates moving up as strongly as they have. Let me show you that quickly. Everybody was watching what Jerome Powell was going to say in terms of trying to talk interest rates back down. So here's the 10-year yield, and this is really key for the this is the barometer of interest rates that goes around the economy for for car loans and credit card rates and most importantly the 30-year fixed mortgage. This is the yield on the 10, and we're supposed to hold 1.314 support. Broke, should have held resistance. Was also at the 61%. We kind of pushed through. So. That's certainly interesting, and rates moving up. It's not a great thing specifically for growth stocks because growth stocks are the stocks that trade with high valuation with the indication of the hopes that they will pay off handsomely with big profits years down the line. That's why, stocks like Tesla with not a lot of earnings and a very high price equates to a high PE ratio. You contrast that against old economy stocks like financials and industrials, companies that are solid, that aren't as volatile, that are making consistent profits. It's hard to make that argument that do you want to have a lot of profits down the line or more steady, reliable profits now? And the same argument can be going for fixed income, which is, okay, now you start to make some respectable yield on fixed income. Why do I want to hold tech stocks? Plus, a lot of these companies are borrowing a lot to fuel their growth, and that the cost goes up to service that debt. Okay, so the Fed meeting was interesting. They upped their economic projections. I think they were looking for rates to remain on hold through 2023. I think, looking at my notes, 7 of 18 voted that Fed or indicated that rates would be on hold through then, and that was up from 5 of 17 votes at the last December meeting. Inflation's expectations were sort of anchored. We're not really getting any kind of reliable or consistent move up in rates. Let me just show you that. So this is the PCE price index, personal consumption expenditure. And of course, the 2% level is what the Fed is trying to get above on a sustained basis. It used to be that if it got above 2, the old Fed playbook would say we're going to raise rates. Now they're saying we're going to not only tolerate it, but hopefully embrace it. So, this is all we've seen in terms of prices going up. It's not very much. Okay, it's a long way from being above 2 on a sustained basis. So that's fine. GDP was expected to grow now by 6.5%. That's up from 4.2% this year. Unemployment rate expected to drop down to 4.5%, then on down into the 3s over the next 2 years. So some pretty impressive numbers coming from the Fed, some projections. And one thing I want to show you here is this is interesting. So interest rates are important. And again, I just spoke about what that means for increasing interest rates, and that's why we're seeing so much rotation. So now let's compare short-term rates like the 2 compared to the 10s. So 2 years compared to 10s. So this is an interesting chart here. This is the 10 minus 2. This is the yield spread, okay? 10-year rate minus the 2-year rate. That's going to be in purple, overlaid on the S&P 500, which is in orange. The gray here are recessions. And what's interesting about this is you can see that the yield curve is steepening. What that means is the longer-term rates are moving higher than the short-term rates. Short-term rates are where the Fed operates, at the shorter end of the yield curve. As the Fed moves their interest rate, that's going to impact the shorter end. They don't have so much control at the longer end, except for quantitative easing, which is buying of mortgage and treasury securities, which they don't have as much direct impact. So if they're leaving the short end flat and we're starting to see interest rates rise, that's creating a steepening yield curve. It'd actually be opposite for you, looking like this way. That's the steep yield curve. So that is shown here in purple. So you see a steepening yield curve, a little drop here in 91, 92. I think that was the start of the first Gulf War, I believe. And then same thing, this is the 2000 pop, S&P drops. Yield curve is very much steepening. Recession back there. 2008, obviously, and we saw a steepening there of the yield curve, and the S&P dropped. And what that means is if the yield curve is inverted, shorter rates are higher than longer term rates, that is indicative of an overheated economy. Feds raise rates too quickly, probably choke off the growth. When the yield curve gets steep, the market's already falling, but the Fed is trying to engineer a steep yield curve, which steepness is indicative of a strong underlying economy, which means that the stock market should follow. What's different this time is we don't have stocks, and we don't have stocks falling while the yield curve is steepening in this recession, unlike what we saw in 2008, 2002, 91, and back here into the 80s too. Okay, so what happened here? Well, it's not really a recession. It was a natural disaster. It was a pandemic that put us into recession. So is this time different? I kind of think it is. All right, so that's that. Let's take a look at where we are in the broader markets in the NASDAQ, which is going to be obviously so key. This is the NASDAQ wave count that I was looking at here with the trading analysis team back here. This is a couple days ago. Where's the date on this? This is a couple days ago. So looking for this possibly to be an ABC correction, looking to sell off down into this zone. I did put a hedge on using NDX options, which I did twice in the last couple of weeks. That is right here on this guy. So we'll go over here to the Analyze tab, and I'll show you this quickly. I put on in this account this guy right here. So I sold 4 puts at 12.60, bought 2 at 12.9, and bought 2 at 12.3 to give this butterfly approach. So max risk was about $6,500. You can see here in blue. Max reward would be just about $52,000 if we were to get down to $12,006. Now, why did I do 12.6? Well, I was just trying to get down into this zone right here. I wasn't going to take it, like do one fall swoop down into the 12,000. I was trying to take it one step at a time. If we got down to there, I'd adjust and push and put on a new hedge. I'm still carrying a lot of tech. Too much tech right now. I do need to sort of rebalance and get some other exposure here. I've got some cash accounts that are not at long-term capital gains rates, so trying to beat the tax man on that and get over the 1-year mark. So I still have a lot of tech exposure. I do need to rotate, and we're going to talk about that in a sec here in the video. So I have updated the wave count. Here's where I think we are in the NASDAQ now. I don't think so. This was the 195, which is a half-day chart. I'm almost wondering, guys, if we're doing this. I'm almost wondering if we're starting to do blue 1, blue 2 up here to February 11th. Almost wondering if we're going to do a little bit of a triangulation, which would take us into March, April, May, then one more push up, which is very much against the old stock market saying sell in May, go away. It's starting to feel like we might just kind of go sideways here. So I might dump that 12.6 put butterfly, maybe just do an at the money butterfly just to kind of collect some theta here, not do anything with my positions, just collect some decaying options and hopefully get the push up and out there in the NASDAQ. Okay, I want to show you some other macro charts here. So this is the 10-year yield right here on the left over the NASDAQ on the right. You can see there's a pretty good relationship there as yields are moving up. NASDAQ has actually started to move up, except till we got up around this 1617 in the 10-year. NASDAQ started to get a little bit of, give us a little bit of pause. And what I would say about that is, if you take the current inflation rate, okay, compare that to the yield on the 10-year, that's called real rates. You have nominal rates, which don't include inflation, plus real rates, which do include inflation. I mean, they're barely positive. I think they're like 30 or 40 basis points. And my argument with that is like, okay, everyone's selling technology because they're overvalued and interest rates are moving up. Yeah, but your effective yield is practically nothing. I just don't see this move up in yields as a tech killer, as so many people are trying to say. I just don't see it. All right, so from there, with that being said, we are seeing sector rotation. Let me continue on the yield, 10-year yield path here. Look at the correlation here with financials. And we are seeing a pretty impressive correlation as the 10-2 curve steepens. XLF, which is financials, is tracking very closely behind. And that's kind of the heart and soul of financials, what they call net interest margin. Financials, generally what they say is they like to borrow in the short term from you and I as we put our money on deposit, and then they lend in the long term, making a larger spread. So they pay a little bit to borrow from us, and then they receive a lot to borrow long to other customers. So that's called net interest margin, which boosts financials. Plus, I think the investment bank and asset managers, I think we're seeing more volatility, which generally is good for those guys. Okay, so this is sector rotation. So with this move up in rates, we are seeing pretty good rotation. And these are the 10 major sector spiders that make up, these are the 10 sectors that make up the S&P 500. So as I kind of rotate this, let's go back to February, okay? February 2nd, my 40th birthday. Okay, so I'll just give you the acronyms here. So XLRE is real estate, communications, technology, utilities, discretionary, healthcare, energy, financials, materials, industrials, and staples. And what I want to point your attention to is as we're up in the top right-hand corner here, that's viewed as strength, okay? Markets generally rotate on a clockwise basis. If you're in the top right, you're strengthening. If you're down here, you're weakening. Down here, you're lagging. And up here at this quadrant, you're starting to improve. So XLK, watch this guy right here. This is technology. He really takes a dive. Okay, this is in the late Feb. And then he actually goes into the lagging, almost one of the weakest sectors here, March 9th, besides consumer discretionary, real estate, and utilities. Technology is very, very weak, okay? Discretionary is not doing very much, but what I'll draw your attention to is look at XLC Communications. That's Facebook, that's Google, that's this new age communications ETF. Look what this guy's doing lately. He is hanging over here on the right. He hasn't pushed up yet, but very, very strong. The other ones that I'll draw your attention to is watch this trio: materials, industrials, and financials. Oh, also you can put energy in there. This thing's got a massive beta. It's so overreacts to the benchmark, which is the S&P right at the intersection of the XY axis here. So watch this. Yeah, financials, energies, industrials, materials rotating in big time. Now, what I would say here as we get out to March 10th, end of the week, the guys are starting to fall out here. Energies, financials, industrials are starting to fall out, even communications. And what's coming on? Technology, discretionary. Watch that one. In utilities, I don't really pay too much attention to utilities, but pretty good rotation there. So financials, tech, and everything we're seeing with the move up in yields, financials moving up, the move up in yields, that's starting to indicate it's actually coming off. Industrials, materials are coming off. I wonder if we're going to see a rotation back in, and that triangle that I showed you on the NASDAQ could in fact play out. The other thing I wanted to talk about quickly is crude oil. Crude's been a big move up. We've seen a big move up, and again, there's a lot of correlation here with the 10-year yield and crude. So this guy is moving up, right? And yields moved up, but all of a sudden crude oil just backed off sharply, okay? And if you think about it, crude oil is going to move up for the expectations of inflation, right? If inflation's expected to go on the rise, all commodities priced in dollars, there's more dollars chasing the same amount of commodities, so they pushed it up. Plus, we have a recovering economy, so people are going to be traveling again, coming into summer driving season. Airlines are starting to do well, so airline consumption of energy is going to come back. But all of a sudden, we just got a pretty good report out that supply was just increased. Let me see my figures here. Yeah, so inventories actually increased the last 4 weeks in the U.S. Plus, we're getting some OPEC, more supply coming to the market. But I also saw there's European COVID cases that are increasing, and people are saying demand for crude is going to come off. I think it's kind of hard to make that argument because everyone's so hot and bothered about inflation, saying that all of a sudden demand is going to come off in crude because of COVID's possibly coming back in Europe. Maybe, we'll see. But I think that this macro relationship is going to help top out the moving yields, bring it down, and I think, again, that's going to help that technology kind of rotate back in. The other thing is I saw a pretty good joke here from my buddy on lumber. He's a contractor. He owns a nice house building business in town. He goes, hey, do you want to take your wife to an expensive business here? Check this out. Okay, guys, we're going to leave it there. Long video. I hope that helps. And throw a thumbs up if you made it on the YouTube window this far. I appreciate it. I am so late to get down to my wife's real birthday in New Jersey. It's a 3-hour drive. I got to do it in 2.5 hours. Okay. Thanks for listening, guys. See you later.